Hello, thank you so much for tuning in to this episode of Lowcountry Money Talk. Phil, nice to see you.
Good to see you.
Phil Bloyd at the desk with us once again with Revolutionary Financial Group. We have a whole lot to unpack. Today's topic is a big one, and I mean that kind of literally. We're going to talk a little bit about this debt ceiling debate.
Sure.
We've got some clips to listen to kick off our show from some former presidents, current Speaker of the House. Let's take a listen.
I think it is terribly important that the Congress pass a clean debt ceiling and do it immediately so that we can honor the full faith and credit of the United States and so that those Social Security checks can go out at the 1st of March.
Social Security checks and veterans benefits will be delayed. We might not be able to pay our troops or honor our contracts with small business owners. Food inspectors, air traffic controllers wouldn't get their paychecks.
Unfortunately, the president would not take yes for an answer. Even when we thought we might be close on an agreement, the president's demands changed.
They have difference of opinion on both sides, but if the Senate has a different opinion, pass a bill. How Congress works, if you just go back to Schoolhouse Rock, House pass a bill, Senate pass a bill, they can go to conference, and the president can then decide. But the one thing I do know, Schoolhouse Rock, they never told you not to negotiate. They told you to work together, and that's what we're doing.
Okay, so there's a mountain of debt, as we know. I mean, we're talking almost $32 trillion in debt. That's a whole lot of money. So for our retirees who are watching or those nearing retirement, how can retirees expect, because I think expect is the right word here, that this is going to affect them?
So it's crazy when you think about Washington, D.C. I flew by there recently. I counted at least 20 cranes, construction cranes, building. And I'm like, wow, I'm not used to seeing that. Washington, D.C. is bloated. Yeah. And it continues to be bloated. It's one of the wealthiest cities in the world. Wow. Because the people there are deciding where $4.8 trillion is going to be spent, what countries and organizations. People are flying in from all over the world to get their cut of that 4.8, plus the other 1.5 to 2 trillion that they spend over what they receive in the 4.8 is the tax revenue. Right. Okay? So they're building to house all these people that go to Washington, D.C. to get our money.
That's an interesting way to think about it. And
that's why it keeps expanding. As the government continues to expand, they claimed victory on a 1% reduction to our debt, to our spending. 1%, that's a victory. And they said, well, that'll reduce our spending by $2 trillion. The spending that last year that normally a lot of that was COVID spending still. Yes. So they cut 1%, and they're like, we won. I'm like, that's not a great deal.
Celebrate.
If I have an IRA that is pre-taxed, hasn't been taxed, and I have this kind of spending, I should be concerned. Yeah. I should develop a plan so that I can outfox these people. Right. Because they're not the smartest people in the world that work there. We say not the sharpest knife in the drawer.
That's right.
Okay.
The brightest crayon in the box.
Right. So they've got us with all of our money buried in a tax trap, IRA, 401k, pre-tax, whatever. And we've got to develop a plan to get out of that thing. So when I have a pre-tax plan like a 401k, an IRA, a SEP plan, whatever it may be, I better have a tax plan to go along with how am I going to unwrap that thing. Yes. Okay?
Well, and that's what's so interesting. I never really thought about that, but it is so important, especially as the debt continues to, hasn't gotten smaller. No. And, you know, we're going to have to figure out where that's going to be accounted from us. Yeah. So you better plan on that. We're going to learn a little bit more about how and where and when and why and all of the questions we have for Phil on that after the break. So stick with us as we work through it. We'll be back with more Lowcountry Money Talk. Welcome back into Lowcountry Money Talk. Good news for you if you're just tuning in. Hey, we're talking about debt.
Oh,
Well,
everybody loves it.
the national debt, the debt ceiling, how it affects us all. So we're going to talk about that now. We're actually going to dive in and discuss the specifics of how it could affect you. So if we have money, we're in retirement or nearing retirement, we have money in mostly pre-tax, we need a tax plan. Super important. So let's talk about that, and then also how is this all going to come back to affect our Social Security?
Right.
Because some people don't think about that. I know I wasn't thinking about it until you pointed it out. So
It's a
talk
big
us through it.
thing. So let's talk about this. So this debt ceiling increase means over 2 years that our debt's going to go from 32 trillion to 36.
That's
pretty much guaranteed. It's a spending plan.
I have no words. Right, yes.
If you give a department, here's $4 trillion, make sure you spend it or you won't get any more.
Yep.
In the government, they're going to spend all that pretty
Of course,
quick.
yes.
So they're going to add another 4 trillion to the 32. So we'll be at 36 trillion in 2 years. Service on the debt, paying our interest on government bonds and positions like that, is going to be more than what we pay to fund our military.
That is
in a
just
year.
wild.
So we could have a complete new military for what we're going to pay in interest on our debt. Wow. So we fund into military about 800 to a billion to $1 trillion a year, and pretty soon service on this debt is going to be $1 trillion a year.
Wow.
So we could have an entire new military just by the interest we're paying. And also that's going to push that debt up a lot faster too.
Absolutely.
Because they're just going to borrow that to pay
that.
more. Yeah. So let's get to Social Security.
This is a wild circle. Okay,
Right.
Social Security, yes.
Okay. So people need to understand that their Social Security may be taxable. Okay. A lot of people think of it as, well, what's it tax? Why is it taxable? Okay. So here's the thing. If I make, depending on if I'm married, filing jointly, if I'm single, there's categories on how much of my Social Security based on my provisional income, a term that the IRS uses to determine how much they want to take back, how much is going to be taxable. So if we're not careful in unwinding our IRA, up to 85% of our Social Security may be taxable.
Right.
So if I'm receiving jointly, let's say $30,000 a year in Social Security, up to 85% of that could be taxable depending on my provisional income. Now, in that provisional income configuration, which we've been over in this program before, they actually count half of my Social Security in the calculation. So if I'm married filing jointly and I take half my Social Security, I take all of my IRA distributions, I take all my pension distributions, I take all of my 1099 interest and all the dividends and everything that's coming, if that puts me over $44,000, up to 85% of my Social Security could be taxable.
And that can happen so easily. So
And it's taxable, Jessa, at my highest income tax rate.
Right.
So if my rate is 22%, then I would take 85% of my Social Security times 22%. That's what I would owe in taxes because now my Social Security. So then we back it out and say, what if I could figure out a way where my Social Security wasn't going to be taxed? Or instead of 85%, maybe 50%. Okay? So that's what we want to do the tax planning for.
Right.
To find out, hey, can we get that down? Can we change that? Maybe we don't take as much. Now, there is one thing that doesn't count as provisional income. There's a couple of things, but the most prevalent is distributions that I take from my Roth IRA or my Roth 401k.
Wow. It's so eye-opening because I don't know about viewers at home, but again, tax planning, and you think about your taxes each year and that sort of tax, but the amount that it could affect you if you do not have a plan in advance is just, it could be, life-changing. So really good stuff, really important. When we come back, we're going to talk more about this topic, of course, about tax diversification. We've heard Phil talk about the buckets, so we'll get to all of that. Can we do that today? Okay, good. We'll do that next here on Lowcountry Money Talk. We're back on Lowcountry Money Talk. Phil is walking us through the multiple plans that we need. And it's so easy to get caught up in needing a retirement plan that you might forget you need a tax plan.
Yeah.
We've talked about that tax plan and the importance and what those implications could be in regards to your IRA. Now, though, and I love this topic because you paint such a picture for us that helps us really understand it, Phil. We're going to talk about tax diversification.
Yes.
And, well, we're not. I would love for you to talk about that.
I'll talk about it a little bit.
Walk us through it.
Okay. So there's different monies that can be taxed at a different rate. So we have the tax buckets we always talk about. We had a whole show about this. But so we have an IRA. So we talked previously, when we have an IRA, we need to have an IRA tax plan, how we're going to unwind that. I mean, or how much do we want to take out of this, because it can affect the taxation of our Social Security. Matter of fact, the money that we take out of our IRAs is the #1 contributor to our Social Security being taxed. So we look at that. The other thing is, what about the other types of accounts and how are they going to be taxed? Well, let's take a bucket. We'll say we have one bucket that's our capital gain bucket.
Okay. Yep.
Okay, this could be from a brokerage account, could be I sell a property, whatever. So in this account, the tax rate is going to be from 0
Okay.
to about 20%.
Okay.
So we can kind of control this based upon what we choose to sell and not sell. So I'm going to talk from the equity standpoint,
All
or
right.
from the stock
Yep.
standpoint for a second. So I have a stock that has increased, over the years, 500% or whatever it may be, okay, over the years. And then I have some newer ones that are maybe down 10% or, something like that. So I say, okay, I need to take $10,000 out. Now, currently we're taxed on realized gains. So as long as we don't sell anything, we don't pay any
no
tax.
taxes to pay.
Right.
Right, okay.
They're trying to change that where they tax it. God forbid they ever do that. That would be a nightmare.
Okay.
But let's say I sell enough of the gain of this stock against the loss of this stock, so to get $20,000 out that I need for income.
All right.
So if I got a $20,000 loss and a $20,000 gain, what's my tax rate going to be on that $20,000 in income that I withdraw from that bucket?
Well, if you're taking a gain and a loss, then net 0.
I like it.
Right?
We like 0.
Yeah.
So we can kind of control that. Now, normally we don't have many losses, okay? The market has given us some of the last few years, but that's one thing we can kind of control. The middle income bucket, that's where most people have their money, and that's also our IRA bucket.
Okay.
Our traditional IRA.
Yep.
So the income tax on that can go all the way up to over 37%, or right at 37%.
Ooh, that's a tough one.
That's a tough one. So unfortunately, that's where most people are taking their money from in retirement.
Right.
And then that leads to the taxation of their Social Security.
Right.
So technically, even more than 37%, because it's causing their Social Security
it's
to be
creating a ripple effect here. Okay. Yeah.
So we want to be really careful about taking from that bucket, okay? Because it may be the highest taxable bucket, and it also contributes the most to our Social Security being taxed. Then we have the 0 bucket. Another 0 bucket.
This is a
possibly.
good bucket.
Yeah. This would be the monies that we already paid taxes on. Maybe we had a traditional IRA and we did the conversions and we paid the taxes on this years ago. Mm-hmm. So now we can take withdrawals out of this bucket and we pay no taxes. Now, as a percentage of assets, how much do you think that we have in that bucket compared to the other two?
Probably not enough. Can I just guess
You
it's
can say
lower
not
than
enough.
it should be? Yeah.
That's right. But then the point being is that's usually the smallest bucket
Right.
that I see, but it's the most beneficial.
Right.
So
right.
in our diversification of income tax planning, we need to consider these 3 buckets and how to get more from at least this middle bucket into that far right bucket.
That is so
1-0
interesting. Yes. Okay. So balancing the bucket. Now you don't need, not just
Not
balancing.
kicking the bucket.
That's right. Don't kick the bucket. You got to balance the buckets.
Yes.
This is so interesting, but I love how you paint this picture for us so that we can understand it, make some adjustments.
Yeah.
Speaking of making adjustments, if you want to have Phil and his team take a look at what you have going on, so that you can make some adjustments. Now is a great time to do that. They call it the Revolutionary Wealth Review. There's no cost to do it. All you got to do is call Rachel at the office. She'll set you up if you have $500,000 or more in investable assets. They'll take a picture of what you've got and make sure that they can give you some help to adjust as needed.
Adjust the buckets.
Adjust the buckets. Don't adjust the dial. We don't have dials anymore, but stay right there. We'll be back with Lowcountry Money Talk. Here on Lowcountry Money Talk, we've been talking about 2 fascinating topics. They are fascinating.
Yes.
There might not be
To me.
positive words in our lives, but we're talking about debt and we're talking about taxes, national debt, but your tax picture. And Phil, one thing that we've, just the theme keeps reoccurring is the importance of having a tax plan.
Right.
And I know there are viewers out there because, I've been in this situation myself where you're not taking a long-term approach to tax planning in regards to your retirement. Instead, you're going year by year and just really kind of trying to manage your current year's tax liability. So what do we do? Because it feels overwhelming to start.
Sure.
How do we start making sure that it's a long-term plan?
Right.
What are you going to do for us?
The first thing we need to do is take a look at the evidence.
Okay.
I need to see your tax return.
Yeah.
Okay. So actually that's history,
Yeah.
right? Because
Yes.
it's already happened. So, but I can see a lot from that, like the mistakes we're making. How much did we take out of our IRA? Did we take more than the minimum? Did we take any and we didn't have to? So we want to look at that.
Okay.
How much of your Social Security is taxable right now? It's going to tell me. The one thing I like to look at is what's going on with that first bucket in your capital gains. Do we have any losses carry forward, some things we could use to our benefit to get some conversions done? So the first step is let's see where you're at today, and then let's make a plan on get us where we want to be. We talked about the marshmallow test on a few shows back. Instant gratification. Retirement planning is a long-term thing, okay? So, 1 year, this year, that year. A lot of times people are chasing the dog around the tree. It's like, hey, you're behind the thing. They're chasing performance. They're like, oh, I want to move my investment from this one to this one because it did better last year.
Right.
Not the year that we're currently in. So we want to make sure that we don't get behind and we're chasing things. We want to get ahead of things. So, and another very difficult thing, probably the most difficult thing, develop a plan is one thing.
Yes.
So you've made the commitment, we've put the time in it, we've sat down several times, we've got the plan all. Okay, then guess what we got to do next?
Do we need to follow the plan?
That's the problem. So people get off the rail. You ever heard of chasing rabbits, right?
Yeah.
So I'm walking down this nice nature trail. I got to be from point A to point B, and a rabbit jumps out, and I lose my mind, and I start chasing a rabbit, and I'm all backwards and in the woods and lost, and I'm not going to get to point B because I'm back here chasing around this rabbit, which is unimportant and not going to lead me to success. So one of the biggest things I see is people get off the plan.
Right.
And then, I'm here to remind you, hey, you're off the plan.
Right.
Okay? Or people say, well, hey, Phil, this one didn't work out. And I'm like, did you follow the plan?
You need to follow the plan.
And they're like, no. I'm like, well, it's not going to work out.
Not going to work. Well, and that's if you focus on the outcome, and that's what I want to talk about here next quickly, is the outcome of having a plan that you then follow. What is the quality of life difference that we stand to gain from tax planning for the long term?
You have a vision and a plan. You expect taxes to get worse. It's not a surprise to you. You have an investment plan. When things happen in the market, you're like, oh yeah, we planned for that. The stress level goes down, the enjoyment goes up, and the money stays steady. Because we've already considered all the things. The government is going to continue to go into more and more debt. It's a fact.
It's a fact.
It's not going to change. Like I said, this plan guarantees that we'll be $4 trillion more in debt in 2 years. Everything's going to cost more. Taxes are going to go up. You know, we sunset this tax plan that we're currently in 2026. So make a plan that takes all that into an account.
Absolutely.
And then you're like, yeah, we already planned for this.
Right.
And you can go enjoy your retirement.
Doesn't that sound good? All right, we're gonna wrap this up, put a bow on it, send you off to the next thing. But what we've really learned here is that you really need to have an effective tax plan. This is a forward-thinking project. This is not, like you said, Phil, you got to get ahead of it, get all those potential tax savings, in comprehension with your retirement plan. It all works together. You can do that if you feel like you are behind and chasing it every year by calling Rachel at the office. Go ahead and have that revolutionary wealth review. It really is eye-opening. It's really smart to do it. They'll help you get on a plan that's going to give you that better quality of life. Rachel will take your call if you want to set that up. And Phil, what a show.
Yes.
I learned a lot.
Enjoyed it.
This is great.
Right.
We'll see
Make
you
a
next
plan.
time. Make a plan. Well, make a plan to watch our next show. We'll see you then.